G'day everyone, Yianni from OzPlan Financial Services. Today we're going to cover off financial considerations when moving into a retirement village. Quick disclaimer, this is a presentation for information purposes only. This is not personal financial advice. Please do not take any of this information as recommendations or suggesting what you should be doing with your own personal situation or circumstances. Always seek professional independent advice before making a decision. So let's jump straight into what retirement villages are. By legal definition, they fall under the Retirement Villages Act 1986 as a community where residents are aged 55 or older, retired from full-time work, or are partners of someone who is. Residents receive housing and services, not including aged care or residential care services, and at least one resident paid an upfront fee, or not rent, as part of their contract to live there. This payment could be a lump sum or paid in installments, and it doesn't matter who paid it. So what do retirement villages offer? Essentially, they're offering you independent living options, and they're typically complemented by shared amenities such as meeting rooms, libraries, swimming pools, and in some circumstances, there are also gymnasiums, bowls, and other sort of shared common areas. Many villages also provide sort of lifestyle services and opportunities for social engagement, such as organised outings, shared meals, arts and crafts, visits from doctors or allied health professionals. While staff may have healthcare experience, retirement villages typically do not provide healthcare services, and they can be run by both for-profit or community organisations. Now, there are various costs associated with moving into a retirement village, and typically we look at 5 with our clients on top of their general living expenses. So firstly, we've got what's called an ingoing contribution. This is an amount you pay to occupy the home in the village. Sometimes this is called an entry contribution. We then have what are called general services charges. So these are similar to body corporate fees, and they cover expenses such as running the village, insurances, staff, and maintaining communal facilities and gardens. And typically these fees and charges are charged on a quarterly or monthly basis, with some villages providing additional services such as cleaning linen, meals, and care services. We also have what's called a deferred management fee. So this comes off the purchase price on exit, and it covers ongoing maintenance costs associated with the facility. This is calculated using a percentage of your ingoing contribution or entry contribution, or at the resale price of the unit. It really depends on the contract terms. And usually the deferred management fee increases with the length of time a resident lives in the village. So it could be over a 5-year period, for example, 5% per annum on the entry contribution or ingoing contribution. We then have a long-term maintenance fund, which is almost like a sinking fund, if you will, and it's a financial reserve to cover significant costs or non-budgeted items. And these again vary with contract options and facilities. Finally, we have exit fees, and this is where we marry together the deferred management fee, any refurbishment or reinstatement costs if you need to bring the unit or home back to a level that you initially purchased it at, which may include carpets, new kitchen, etc., or flooring. And then there's selling fees. So these could be agents' fees and may be quoted to you on a percentage basis. For example, 1.5% of the sale price of the unit. Now, as mentioned, these costs vary from facility to facility, and even within a facility, there could be a number of different contract options available. So it's always important to ask for at least a draft contract, which then you can take to a financial planner and solicitor to have reviewed and understand what the different implications could be to you, depending on which situation or option consideration you'd wish to proceed with. I've got here a working example of the retirement village costs applied to, for example, a unit valued at $800,000. So we've got the ingoing contribution, that's what you're paying up front, $800,000. That secures the unit or the home in the retirement village. In this working example, we've estimated that there won't be any capital growth applied to the unit, and the facility provider or the contract states that you won't benefit from any capital gains. Even if there was a capital gain, should the share of capital gain be zero in the contract, you will not benefit from the capital gain. We also have refurbishment costs in this working example of $20,000, which will be payable upon exiting the facility, with estimated selling costs at 1.2% on top of that $20,000. So as you can see on the right hand side of the table, we've got years 1 to 10. From year 1, you will notice that the exit entitlement is less than the initial contribution or the ingoing contribution. What that's derived from is essentially a 5% deferred management fee, which we've applied for the first 5 years. So you're subtracting 5% on the $800,000. And then we've also got the $20,000 coming off as a refurbishment, as well as 1.2% for estimated selling fees. So every year, your exit entitlement will reduce up to the 5th year, where it will then remain fixed. And that's because we've got the 5% deferred management fee for the first 5 years, and the remaining costs are fixed, being the $20,000 refurbishment fees and the estimated selling costs at 1.2%. Again, no capital growth, hence why the value of the unit on exit remains at $570,400 over the long term. Here is an example of a bit more of a detailed consideration that we take, that we analyze with our clients, and that is, are you better or worse off moving into the retirement village financially, and can you afford this change in your lifestyle? So what we've got in this working example is current situation. Clients are living in their home worth $1 million, and they have financial assets outside of the home, including cash, shares, and some super. On the other hand, we're moving into the retirement village at $800,000. So we've sold $1 million home, we've put up front $800,000 to secure that unit, and we've got an extra $200,000 now, which we've just put to a cash account. So what that means is, yes, we're freeing up cash going in, but if you're on the age pension, that means that assessable asset potentially could reduce your age pension, and that's what's happening in this working scenario. Initially, their age pension combined was $33,000 a year, but on the move to the retirement village, because the entry contribution was less than the value of their primary place of residence or home, we've got more assets that are being accessible for Centrelink purposes, hence why we've got a reduced pension entitlement. So that reduced pension entitlement may or may not create an issue for the clients, because they now have less income coming in and may be required to draw on capital from their investments at a much greater rate. Below that, we've got the cash at bank. So you can see in the current situation, there's about $250,000 in cash. Once you've moved into the retirement village, we've been able to put away $200,000, so that has resulted in that increase in the cash balance. However, that income or the interest that you're earning on that additional $200,000 is not enough, as shown in the income section below, where we've got less income as a result of moving into the retirement village than if we were living in the home. If we look at the total expenses, we may have slightly lower expenses from an ongoing perspective in the retirement village, because there's less maintenance that you've got to worry about that's out of pocket, and typically you may have rates and services as part of your general services charge. So what we can see in this working example is the clients are about $8,000 a year worse off from a cash flow position, and that's predominantly linked to the reduction in the age pension because we weren't able to reduce our assets. So this brings us to the next point, and that is a client must, in this circumstance, seek advice to determine whether or not this transition can be sustainable and if possible, how can we further enhance their financial position? For example, it may require us to reshuffle assets in a way where they're more favorably treated from a Centrelink perspective. For example, using an annuity where we're able to reduce assessable assets. Or there could be other provisions that we could explore that may be able to help that balancing act of getting that age pension entitlement back up and helping recoup some of that negative cash flow. So how we can help, we've got 3 service offerings that we can provide to you. We've got an initial meeting, which is general in nature. We're providing you with general information. We can review the costs associated with the retirement village of your choice, and we can discuss the different contract options available to you from a financial perspective. Moving forward, we then have a more complex sort of arrangement where we can provide you what's called an options paper. It's essentially a very detailed review of the financial outcome when transitioning to the retirement village. And this gives you a greater idea of your income, your expenses, assets over time, including the estate value, and also your age pension entitlements. From there, we can also provide what's called a statement of advice, and this covers strategic planning or personal advice, where we're recommending strategies that can potentially further enhance your financial position and reduce any implications as a result of your transition to a retirement village. Always, if you've got any questions, feel free to call our office on 90786454. You can shoot me an email, and I'd like to hopefully see you in the next video. Thank you.